There happened some mistakes. So I said we have a keynote now, but what do we have exactly? So what can we expect now from you?
Well, after the grim intro that you said about what startups should expect, I'll be talking to you about our sector. We are in the business of helping other businesses grow. So I want to tell you something that we've observed and show some numbers how we help companies grow.
Okay. So sorry for my side, that was a mistake, but Amir, nice to meet you. Give me maybe just an insight, or also the audience here on stage, but also online, who you are. Yeah. So maybe a short introduction
who
you are.
I can do it here.
Or maybe do
I have a slide for it,
but spoiler on your presentation.
So once again, my name is Amir Novak. I'm the Chief Product Officer at Fulfin. Fulfin is a German Munich-based startup which provides fast and simple financing to young companies, especially in the e-commerce space. And we also support them with various data insights so that they have the right data to make the right decision about their growth.
Okay, so thanks. I'm gonna give the audience to you.
Thank you very much. Thanks everyone for being here. As I said, the introduction from Hannes was quite grim. Growth is more difficult. Companies are closing down. People are getting fired, but we see that even despite these challenges, there is a way to grow and grow even faster than you have done before. As I said, that's the business in which we are in. We provide financing for companies to help them reach their full potential. Well, my intro you've heard. A few numbers about Fulfin. So two simple words to describe Fulfin is business lending, but we have become a more complex and well-rounded business since. So we are a data-driven platform that helps growing companies plan their liquidity needs, so to know how much money I need when, but also to immediately access that money through fast and simple financing in Germany. We were founded in 2018. We have now 27 members in the company. Actually, we have around 35 already. We've closed 15 million euro in funding so far, both debt and equity. And that really helped us gain great momentum this year and going into future years, despite the intro saying that there's slowdowns. But we have over 4,000 registered users at Fulfin, and we've originated over 1,000 loans, which is for us going into this year will be doubling our growth compared to last year, despite, again, all the challenges that you've heard earlier. Giving money is tough, but it's not as tough as getting the money back. So I'm very happy that the key metric that we have is very low default rates. So only under 1.5% of our customers, that's the default rate that we have. And finally, we're also well embedded in the e-commerce scene in Germany. We co-own and co-run a leading e-commerce event called Seller Barcamp, where we gather hundreds of e-commerce players in the market and talk about these topics and others. So briefly about today, really it's just about talking about problems that these companies are facing to grow and solutions to those problems. Given our sector, we'll be mainly looking at e-commerce, but they're related to other verticals as well. And looking at it from a prism of financing and of data as the solution to these issues. So barriers to growth in 2022. Especially in e-commerce, a lot of these issues are always there. They've been there, and for foreseeable future, they will remain there. But we now see a new range of new issues that are caused by various recent global events and macro trends that just compound the previous challenges. So if we go down the list, first one is key. There is a persistent need for working capital for e-commerce businesses. They are in a constant cycle of sourcing their products, buying their products, shipping them, packaging them, storing them, marketing them, and only then selling them, even though there are good returns, but there is a long time that it takes, and there's a lot of money that's needed. And that's what we see on this graph. So e-commerce businesses, the business model requires a lot of upfront cash. So it's not that you spend as you earn, you spend a lot at the beginning and then you have very good returns at the end. It can be 50% plus profit margin. So I know that if I sell, 500,000 worth of, if I buy 500,000 worth of goods, I will sell them for €1 million later. But it's all these red yellows that I have to go through first. First of all, we have we find a supplier, usually in Asia, and we come to an agreement that we'll buy a big bulk of goods from them. First, I have to pay my advance payment. So it can be 20%, 50%, it can differ a lot. This is becoming more difficult lately. When the products are made, I pay the remaining balance for that item. Then I pay for shipping so that it's shipped, sent to me. It also takes a lot of time, right? And it's getting longer, as I'll tell you in a moment. Then I spend money on marketing them, and only then I sell them. And only then I'm very happy here at the top with my great returns. And this is happening over and over again, not once a year, but throughout the year several times. Now, what we've seen, especially this year is, well, since 2020, is that not only are the red arrows getting longer, so I'm spending more at each of these stages, but the gaps between them are getting bigger as well. So rising cost of materials, shortage of components means that I have to pay more for my goods. Once I do, I need to ship it. Shipping costs skyrocketed in 2020, hundreds of percents up. It's better now, but a huge jump. And not only became more expensive, it takes way longer. A customer I spoke to just last week said that what took 1 week before to ship now takes 4 weeks. And we've seen companies that have it way, way worse. And even with marketing, since April last year, when Apple changed the way that tracking can be done on them, businesses that grew pretty much entirely on Meta ads platform, Facebook ads, Instagram ads, find it way more difficult to find their customers in that channel. So the usual cash conversion cycle that we're dealing with is 3 to 9 months before they get paid. Then we have financial exclusion. Inclusion we've all heard of, that's the great word. Exclusion is what we see in our space. So what we see very often is a great business with a great product, a great team, great sales, great metrics, but they're still not able to get funding. They're not able to get financing because traditional finance does not understand or is interested in this space. If you're a company that's growing very quickly, but you've been on the market only for 15 months, that's not something that a traditional bank knows how to deal with. That's not how their risk models are built. Then it's the fact that planning your liquidity and how much money you need is very difficult. Cash is king, but also we know that companies don't die because of metrics or because of botched marketing campaign. They die because they run out of money. That's very difficult. You need several tools to do it, and it's very time-consuming. Worldwide survey actually showed for smaller companies that the usual cash reserves that they hold is only 1 to 2 months for their operating expenses, which is way too short. You need at least 3 months, ideally 6 months. And then we have the unpredictability of inventory and logistics. And that's a little Mike Tyson there because as he famously said, everyone has a plan until you get punched in the mouth. So no matter how much great planning you do, you get hit by unexpected things that I mentioned before. Shipping takes longer, it's more expensive, costs are going up, etc., etc. So not only your unit economics are majorly hit, it's the fact that you can run out of cash suddenly. And finally, an all-encompassing point about data and using the right metrics to make the right decisions. We'll touch on that topic later on the slides, but the amount of numbers and metrics that we use to assess a company and underwrite them is way more than the companies use themselves. So we're now trying to make sure that the insights that we use are also accessible to them. Sorry. Now, a quick look and a few numbers of what we've seen so far with our businesses. We see that difference between scaling and not scaling very often is the decision, should I take financial leverage or not? The graph you see here is the average annualized revenues on a quarterly basis for companies in our portfolio. So we see that the companies that are in our portfolio and are getting financed grow on average 300% within 36 months. Our champion companies grow multiple hundreds of percents per year. And that's, this one shows it. This graph shows how revenues grow depending on frequency of financing that you pick. So if you get 3 or less rounds of loans, that's on the left. And if you get 10 or more rounds of growth, that's on the right. And it's a massive difference, showing clearly that external financing truly is the fuel for growth. I'll not go through the details of this table, but this is essentially looking at a very specific real example of a single trade, which you can either finance on your own and buy a smaller bulk of goods, or you can get external financing, for example, with Fulfin, and the impact that this has on your profitability. So on the left, we see in that example, 2,000 units, I get 10,000 profit. On the right, with financing, I buy more units, I get 25,000 profit, despite the cost of financing, which for us is very affordable. So in this single trade example, a company can grow their profit more than 2.5 times. The font is too small for the screen, but essentially this shows the different types of liquidity or like financing that you can gain depending on where you are in the life cycle of your business. I think everyone's aware at the beginning it's bootstrapping, friends and family. I use my personal credit card. Later, I try to get angel investors or incubators. And Fulfin is positioned here where we're dealing with companies that have already gained traction or are really building up that traction, and then the scale-ups. And these can be either e-commerce players that are selling on traditional marketplaces on their own website, but very often we now also see bigger companies that come to Fulfin that have, for example, direct-to-consumer brand. It's venture-backed. They're growing very quickly, but now they use us more and more as a, I won't say to supplement, I mean, not to replace their banking credit line, but to complement their growth with our funding. And the later stage is for the big boys and girls. Now on to data. As I said, we've really mastered our sector. We've really mastered knowing which company is good and what to expect from them. We have a plethora of data that we assess, and we do it quite well. If we look at the different tools that we're currently using, we have our own in-house built engine to tag in real time all the transactions that are happening in a bank account, categorizing them depending on which group they fall under. We have machine learning models to identify the key variables for these companies and then running these simulations on portfolio. Scorecards for underwriting, scorecards even for the seasonality of the business. So we are able to predict what's the seasonality of this specific business and should they get a loan for 3 months or 9 months. And clearly stuff like debt capacity. Now, this really helps us internally, and we thought, okay, how are we able to know all these numbers, but the businesses that we work with aren't using them? So we're now trying not to be another large bank where this is just a black box where no one knows what's happening. We're now repackaging our internal skill set into a product for the customers. One example that we launched earlier this year is the Fulfin Health Index, which is essentially a report that shows you all these different metrics, be it your cash generation capacity, your debt-to-income ratio, etc. And we don't only score you to tell you how well you're doing and what you need to focus on, but we also help you benchmark yourself against the e-commerce sector because we have so much data about so many different companies. Actually, I should also mention, one thing that we really plan to do is, since we think about cash flows and planning them for the companies, it's another tool that we're planning to jump into soon. Again, font too small, but a simple funnel view just to show that e-commerce, Fulfin has really developed from a e-commerce lending expert into a full-stack liquidity partner for our customers. So we started by mastering the lending part of it, but now we see that, hey, we have all the data, we have all this great insight in the companies that they don't have, so why don't we allow them to use our internal tools? And so we have a layer of data insights that we want to provide on a freemium basis, essentially. We have lending that we're doing right now, and we're also now filling in the gap in between, which is shorter-term financing for specific use cases. So 7 minutes left. My final thoughts and key takeaways are growth is tough, especially for companies, for young companies in this space. We have to make sure that the companies know their numbers, that they're able to plan ahead for their liquidity and for their inventory needs, and that no matter how great your business is, relying on your internal finances, be it profit, be it the shareholder loan, is not enough to reach our full potential. So external funding and relying on actionable data insights is absolutely key to growing. And a quick plug at the end, just to make sure that it all flows nicely. We offer fast and simple financing for up to 500,000 euro for clients, especially in the e-commerce space, but also other verticals. And we're rolling out a new range of analytical tools. As I showed you, we've nailed the analytical part of our business, and we want to package it into products for our customers. Thank you. Do we end it there? Do we have Q&A?